Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See detail.
My dad works in B2B marketing. He came by my school for career day and said he was a big ROAS man. Then he told everyone how much he loved calculating his return on ad spend. My friends still laugh at me to this day.
Not everyone gets B2B, but with LinkedIn, you'll be able to reach people who do. Get a $100 credit on your next ad campaign. Go to linkedin.com/results to claim your credit. That's linkedin.com/results. Terms and conditions apply. LinkedIn, the place to be, to be.
This is Optimal Finance Daily, the near zero benefit from timing the market, by Jesse Cramer of bestinterest.blog. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get right to our next article as we optimize your life. The Near Zero Benefit from Timing the Market, by Jesse Cramer of bestinterest.blog. Bear markets make you question, should I wait for the bottom? In fact, reader Paulson recently wrote in to ask, quote, Jesse, I'm not tempted to sell anything in my 401k or Roth IRA, but I don't know why I should continue buying at this point with the market doing what it's doing. It's not going up anytime soon. Can I contribute money to those accounts as cash and then wait to invest once the market hits its bottom? End quote. It's a great question. You can try, Paulson, but I don't think you should. Today's article explains why timing the market barely affects your future portfolio, is really hard to execute, and makes your life demonstrably worse along the way. The story of 3 investors. We're going to use 3 identical investors to tell this story. Normal Nick, good timing Jerry, and bad timing Bill. All 3 investors started their investing in 1985 when they were 22 years old. They're now old enough to be approaching retirement. Some other facts. All 3 use the S&P 500 for their stock investments. All 3 invested $200 a month in 1985 and have increased contributions by 5% per year until today. They now invest $1,216 a month. And all 3 invest via dollar cost averaging. They buy high, buy low, and buy in between. Except for one time. The great financial crisis threw a small wrench into their plans. Nick stayed the course, but Bill and Jerry got greedy. Good timing Jerry managed to time the market perfectly. He stopped investing at the market top in 2007 and saved his cash. He then perfectly timed the market bottom in March 2009 and deployed his cash. He timed the market to perfection twice. Bad timing Bill also timed the market top with Jerry. But when the true bottom hit in March 2009, Bill was convinced there was more room to drop. As the market recovered, Bill waited. He thought a new bottom would eventually come. So he didn't deploy his cash until 2013, when the market price had fully recovered to 2007 levels. And his wise wife screamed at him to get back into the market. Normal Nick plodded along the entire time, continuing his boring dollar cost averaging buys as planned. Up, down, and in between. Nick just keeps buying. How big a difference did market timing make? Now it's present day. How different are Nick's, Jerry's, and Bill's portfolios? Jerry's is the best. After all, he perfectly timed the market twice. He has $1.46 million. Bill's is the worst, since he missed buying opportunities for about 5 years. He now has $1.38 million. And Nick is right in the middle at $1.42 million. The perfect market timing around 2008 got Jerry a 3% edge over normal Nick. Bill messed up big time, yet Jerry only has a 6% edge over him. Over the long run, Jerry's perfect market timing isn't that important. Selling out is a bigger deal though. Notably, Bill and Jerry did not sell their old investments. All they did was choose to no longer buy new investments. If they had sold old investments and rebought later, our conclusion would be much different. Bill would have lost another 20% of his total portfolio as of today, despite perfectly timing the initial market top. And Jerry's portfolio would be about 50% higher because he was perfect twice. Perfect once, down 20%. Perfect twice, up 50%. Do you feel lucky? I like where normal Nick is at. He didn't worry at all about timing the market. Zero skill, zero luck, zero stress. He just kept on buying, and he's in a great place. Not worth the squeeze. This is a scenario where the juice simply isn't worth the squeeze. The squeeze, again, is double perfection. You have to be right twice. If you manage to be right the first time, ceasing buys before the market bottom, you'll likely be plagued by bad timing Bill's issue. When the market is at its peak pessimism, do you have the skill, the knowledge, the balls of steel to deploy your money? Or are you a dumb market timer like the rest of us? And the juice? It's a 3% boost on your final portfolio. Or maybe this time will be different. Maybe you'll get a 4% or 5% or 6% boost. While your money is out of the market, sitting on the sidelines, what will you be thinking? Are you going to be relaxed with ice in your veins? Or are you going to be a nervous wreck, worried about when to get back into the market? Not only can this squeeze cost you money, but its psychological cost is unavoidable. A Magnify Money poll, take it with a grain of salt, showed that 10% of investors cry from the regret of selling their investments too early, and 66% regret making portfolio choices based on emotion, like the pessimism we're surrounded by at the time of this writing. Jerry gained 3%. Sure, but he also gained some white hair. He was out of the market for 18 months. We're only 6 months off all-time highs right now. Are you willing to wait for another 6, 12, 18, 24 months or more? I'm not. Who knows how long it'll take us to return to all-time highs? I don't want to test my skill with timing the market. I don't want to test my blood pressure by staying out of the market. I'd rather go for a run and play with my dogs. Wouldn't you? You just listened to the post titled The Near Zero Benefit from Timing the Market by Jesse Cramer of bestinterest.blog, and I'll be right back with my commentary. Buy low, sell high. Buy low, sell high. It's a simple concept, but not necessarily an easy concept. Right now, high interest rates have crushed the real estate market. Prices are falling and properties are available at a discount, which means F.I.R.E believes now is the time to expand the F.I.R.E flagship fund's billion-dollar real estate portfolio. You can add the F.I.R.E flagship fund to your portfolio in minutes by visiting fundrise.com/OFD. That's FUNDRISE.com/OFD. Carefully consider the investment objectives, risks, charges, and expenses of the F.I.R.E flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/OFD. This is a paid advertisement.
This episode is brought to you by Atlassian. Atlassian makes the team collaboration software that powers enterprise businesses around the world, including over 80% of the Fortune 500. With Atlassian's AI-powered software like Jira, Confluence, and Loom, you'll have more time to do the work that matters. In fact, Atlassian customers experience a 25% reduction in project duration per year. Unleash the potential of your team at Atlassian.com. Atlassian.
Jesse makes a great case here on why we shouldn't waste our time and energy on trying to time the market. And further to his point, the good news is that you don't need to beat the market to reach your investing goals. Matching the market through buying low-fee total market index funds gets you to where you want to be more reliably and with less stress. While buying low and selling high or waiting for the bottom might seem more exciting, I'm very happy to have my investment portfolio be one of the most boring parts of my life. Investing is not where I get my kicks, friends. According to a study by Dalbar, a leading financial services market research firm, the average investor significantly underperforms the market. From 2001 to 2020, the S&P 500 returned an average of 7.5% annually, while the average equity investor earned only 5.96%. This gap of nearly 1.5% per year is largely due to poor market timing decisions. Even professional investors struggle to time the market effectively. A study by Morningstar revealed that over a 10-year period ending in 2019, only 23% of actively managed funds outperformed their benchmarks. This suggests that even those with access to advanced tools and resources find it difficult to consistently beat the market. Instead of trying to outsmart the market, a more prudent approach is to adopt a long-term investment strategy, focusing on diversification and consistent contributions, which historically has proven to be more effective in building wealth. And that's another edition of Optimal Finance Daily. Thank you for listening, and I'll be back tomorrow, as usual. So I'll see you there, where your optimal life awaits.